and welcome to Trades and Tutorials. This is Jeff Bish, president of MarketGauge.com, and in this video I'm going to show you how you could have had more confidence that this big green day in the SPYs was going to be a breakout over this nice consolidation of 2 days here and kind of get a leg up on the break of the 10-day moving average, which is this magenta. Now, the other significance to this is that if you're watching this and when I've just put it out, you probably remember the unease that that you had, like everybody else, I would believe, after such market volatility. So when you get market volatility like we saw here, this collapse, bounce, slight bounce, collapse again, and then slight bounce, it's easy to be looking at this and say, you know, this is 2 days of consolidation. This really could break either way, which is absolutely true. So that's why this day, as a big green day, is an important day both for the market, but also it was a day in which, if you were looking at the relationship between bonds and SPYs using a simple technique of the opening range, you could have had more confidence and really seen the big day potentially coming. So let me show you how you can do that. I'm going to take the SPYs here and the TLTs down here and turn them into 30-minute charts. And then we're just going to zoom in on that whole down move. Now, the moving averages, just so we can get things straight, the moving averages on here are really not significant in this analysis at all. I'm looking at 30-minute charts so that you could just look at the 30-minute chart and see that first 30 minutes of the day that establishes what we refer to as a 30-minute opening range really easily. As it turns out, I also have these dots, green dots for the high of the first 30 minutes of the day, red dots for the low of the first 30 minutes of the day to act as a visual aid. All right, so there are a couple relationships between stocks and bonds, or patterns, that you need to be aware of to see this coming. They're not hard, but I'm going to start there. So you want to pay attention to, especially when the markets get volatile, what bonds and stocks are doing relative to one another. These relationships come and go, but as you're going to see, if you stick with me through the about 5 to 7 days that I'll illustrate for you, there are certain patterns that just jump out, and those are the days you want to pay attention. I don't want to suggest that every single day you can look at what stocks are doing and what bonds are doing, and it's going to tell you exactly who's going to do what. All right, not suggesting that. Instead, I want you to look at the big obvious situations. So one big obvious situation is when stocks are driving bonds, and what that means is if you have a big sell-off in stocks and a big rally in bonds, it usually means that stocks are scared and money's running to bonds. All right. Now, another situation to watch out for, and this is what happened last week with the sell-off, is that you have a situation where bonds sell off hard and stocks decide they don't like higher interest rates, which is what happens when bonds sell off. So stocks sell off as in a reaction to it. All right, so bonds going down and stocks going down is not what you want to see. All right. The other scenario would be that you have bonds going up and stocks going up. Now, typically, that's a pretty bullish situation, right? If you've got bonds going up and stocks going up because they see lower interest rates and they're responding positively to that, all right? Now, the last situation would be that bonds go down, but stocks go up. So why would this happen? Well, it would go up because stocks are strong enough to not be afraid of higher interest rates. All right, now, what happens when we put all that together? Here's what happens. So last week when the markets were selling off, the extreme volatility was blamed on the volatility derivatives, but the impetus for all of this was blamed on the higher rates, which had been coming. They just seemed to be accelerating, and the result of that acceleration was that stocks got scared. So that's what the media was saying. And if you want to check whether or not the market's actually doing what the media is saying it's doing, here's an easy way to do it. You want to figure out whether or not the stocks have a strong day and the bonds have a strong day, or those relationships I just described. And the easy way to do that is just to pay attention to how each of those instruments are trading relative to the first 30 minutes of the day. Did they have a trend up day? Did they have a trend down day? All right? Was it a mixed day? Now, I'm not going to get into all the patterns that you can use around that opening range to actually trade these trends or these reversals. That's what we get into in our individual courses, and sometimes I talk about them here. This is just, if you use that first 30 minutes as a gauge of the trend for the day, what is the condition of the market? You'll be able to assess it. So let's take it day by day. I think I've got these lined up. I do. Here's the second. Here's the second. All right. So starting from the second, you can see bonds get clocked. Stocks actually hold up a little until the end of the day, and then they come back down. But from an opening range point of view, they pretty much had a mixed day. However, the next day, stocks get hit hard. All right, they get hit hard, and bonds actually had a rough day too. They don't look like a big trend day here because of the way the data is scrunched, but they gapped lower, and they pretty much stayed below their opening range the whole day. So it was a down day for bonds and a down day, big down day for stocks. Now that spills over into the next day. You'll notice that stocks start lower, try to move higher, but then accelerate to the downside, and probably in reaction to the fact that bonds were breaking down below their opening range. All right. Now, this day, however, what happens? Stocks really start to accelerate. You get a big down day in stocks, and you get that pattern that we described earlier, which is bonds have a big up day. Now, this is bonds being the flight to safety now for stocks that are panicking. Now, the next day, stocks open lower. Bonds manage to have a kind of a mixed day towards the upper side, and stocks have a mixed day. So you've got a mixed day in both. They basically start to stabilize. The next day, bonds get hit again. All right, they continue to trend lower. Now, in this case, stocks started to try to move higher after consolidating, but pulled back and have a mixed day. So this is a down day for bonds, stocks kind of mixed. All right, but the next day, as was the pattern over here, stocks get scared again, and they start heading lower. They have a big down day. So here, stocks are scared, and you know that they're scared because bonds head higher. All right, so stocks down, bonds higher, stocks are scared again. All right, again, stocks continue to slide, but this time the bonds actually are pretty stable. All right, and even though you had the initial run up in the bonds in the early part of the day before, they stabilize and move lower. So you have a situation here where you have really two down days in stocks, but the bonds are kind of stable, and they're definitely stable in here, which is suggesting that stocks are moving lower, but they're not. The markets aren't as scared of it as they were before, and you see that reflected in the fact that at the end of the day they come back. All right, and so this is where it starts to get interesting. Your down day in stocks turns around, and you wind up with a recovery towards the end of the day, and bonds kind of telling you they're not scared, right? potential here for the bottom. All right, potential. Now you could have seen this developing and traded it as a bottom, but I want to show you a bigger picture. All right, now the bigger picture is that the next day stocks kind of meander higher, but I would call it a consolidative positive day, right? Because it's not a big trend day. Started lower, couldn't continue below the low of the opening range, end up higher than the opening range, right? And bonds consolidate. And kind of the same thing happens. These are the two consolidation days in the stocks. So you've got 2 days of consolidation days here, 2 days of consolidation in the bonds here. And then here's the key day, all right? This is the big up day in stocks. So stocks break out of their 30-minute opening range and trend higher. But bonds actually break down. They break down out of their 30-minute opening range, right? So this is that day that I described where you've got stocks are breaking to the upside, and bonds are going down. What makes this significant is that this is telling you the up day in stocks with a down day in bonds is, and not only is it a down day in bonds, it's a new low of this whole move in bonds, right? So back here when bonds were up this high and falling pretty sharply, stocks reacted severely to the downside. But here, bonds making an even lower low, stocks are going up, all right? It's completely different than what was going on over here. This is telling you that stocks are now strong enough for whatever reason, right? Forget about what the media is saying, forget about all that stuff. Stocks are strong enough to no longer be worried about the higher rates. Now, this doesn't mean, as you can see from this whole progression, it doesn't mean that that attitude has to continue for any particular length of time. But what it does tell you is that this is definitely a day you want to focus on that opening range breakout, especially when it comes after 2 days of consolidation, because it could lead to more, and it has in fact led to a follow-through day the next day, follow-through day in the morning on Friday, and Friday came back down, and so wasn't a big up day, but it enabled you to get in to a bullish situation after a really rough period. All right, so as a quick recap, if you just pay attention to whether or not you've got one of these really obvious situations with a significant trend in stocks and a significant trend in bonds, and should that interpretation be bullish or bearish? And those are the days when you get those obvious big trends that are going in the right way with the patterns that you want to follow. All right, and it's as easy as just knowing how they're both reacting relative to their opening range and their prior days highs and lows and their general trends. All right, hope that helps, and I'll see you in the next video.